Welcome back to Squawk Box. We have breaking news, our April read on Consumer Price Index. And believe me, if you're standing, I recommend you sit down. Up 0.8% on headline, 4 times expectations. Strip out the all-important food and energy, up 3 times expectations, up 0.9%. Year over year, up 4.2%. And if you look at year over year core, up 3.0%. These are staggering numbers. However, they shouldn't be a surprise, especially let's take those year-over-year numbers. When you look at last April, it was up 0.3 year-over-year headline. So we are comping against some of the worst corona-affected year-over-year inflation data points. So for the next couple months, these year-over-year numbers are going to be rather large. How large? Yeah, I heard you ask. Up 4.2% would be the biggest month-over-month increase on headline year-over-year since September, get this, 2008. These are really, really lofty numbers. Now, as we look at what's going on in interest rates, we're almost at 164 on a 10, 235 on 30s. And do remember, yesterday, once we traded back over that 160 and held, we never traded under 161 even. And I know these are compressed technicals, but I try to keep it simple. Give yourself a couple of basis points for slippage. Use 160 as the dividing line between more bullish, meaning rates go up, prices go down, and vice versa, under 160 pivot. Those should be helpful. And one more thing. If there's any question at this point about how much extra benefits are kicking in to keep people maybe from taking some of these jobs, a couple of things at a postmortem on Jolts yesterday. When you really had a chance to look at it, leisure and hospitality were up 267,000 yesterday on openings, but hires actually declined by 6,000. So as you go through those numbers, it really starts to jump out at you. Joe, back to you.
I had a weird feeling listening to you. It was, I think I would identify it as kind of like panic. That when you actually see inflation numbers when it's been so long, Rick, I really didn't think they were possible. I didn't think it was possible, and I still don't. I think it must be transitory. But for a second, I was thinking 4%. I mean, those are big numbers. And if it were to feed on itself again and again and again and go, I just really haven't gotten my head around that we could really go back to where inflation would be a big problem. I mean, I've seen it before, but it's been so long, I just don't believe it. But I almost felt a bit of panic for a second. Should I?
Yeah, well, the problem is transient. See, markets have a big problem with the word transient because once you start to see inflation, markets aren't going to be pricing in an extended transient period, kind of a buy. We'll let it slide for a while. And even if it is transient, what's transient? 1 quarter, 2 quarters, 5 quarters? No matter how you slice it, the markets are going to percolate a lot more than they have regarding some of these pricing pressures. And in the end, I don't doubt they may be transient. But transient's a twofold issue. First of all, it's going to be a longer form of transient. I don't think it's just going to be a month or two. And the second thing is, once they move to the higher level, they're going to stick. And this is the difference between what middle America and all the experts and economists and analysts feel about inflation. You know, if your food bill doubles and it sticks, that hurts. But if you're measuring inflation from the Fed standpoint, the doubling actually makes the CPI or PPI, whatever it is, a hot number. But once it sticks, that momentum goes dead. And basically the net change becomes the number we look at. That's the issue.
Shepard Smith here. Thanks for watching CNBC on YouTube.